morning, good evening, whatever the case may be. My name is Ty Chapman. I'm the president of 5 Star Metals. Welcome to our first ever video. These will go as a supplement to our newsletter, which many of you are familiar with. First, let me apologize. Our newsletter was offline for all of 2018, but we've decided to bring it back. We're going to bring it back in 2019, probably as a once-a-month email, but we're going to supplement with these videos. We decided to start doing these because, one, candidly, I want to be able to give you information in more real time, and these are a little easier to do. And two, our website marketing guys wanted me to, so I decided to give it a shot. So here we go. I decided there was no better way to start this than with my take for what's going to happen in 2019 with oilfield services and the market. So normally we're going to keep these videos to 2 to 4 minutes long, but in this particular case, because I'm providing you what I think is going to happen in all of 2019, that requires a discussion of a lot of context and where we are now. So this one's going to be really long, and for that I apologize, but just know in the future they will not be nearly this long. So we're going to talk about what I think is going to happen in 2019, but before we do that, to all of our customers, all my friends, we want to first of all thank you for your friendship, thank you for your support, and thank you for your business in 2018. It means the world to me and my family. So let's get into this. Let's first look at oil supply. So I think by far the biggest headwind oil faces in 2019 is the supply side. If you look at the chart below, you'll see that the United States is now producing 11.7 million barrels of oil a day. That is tremendous because that makes the United States not only the world's biggest consumer of oil, but also the world's largest producer. And I want to give you guys some historical context as to that. When OPEC opened the tap in December 2015, the United States was producing right around 9,077,000 barrels of oil a day. OPEC was producing about 33.23 million. So the deal comes out that, or OPEC opens the tap. The United States eventually peaks at 9.6 million barrels a day in June of 2015 before dropping down to 8.4 million barrels a day. When OPEC does its original production agreement, OPEC plus its allies like Russia agree to cut 1.8 million barrels a day to help bring oil back into balance, right? And so since May of 2018, the world has added close to 2 million barrels a day, if not more, of supply. Saudi Arabia's added in excess of 600,000 barrels per day. Russia's added in excess of 400,000 barrels per day and now stands at record production, as is Saudi Arabia. And the United States has added 1 million barrels per day. So the three biggest producers have all hit record production this year. That is tremendous, and we see it weighing, as we're going to talk about below, on the inventories. And of course, the world is increasing its oil demand, and there's a question how much. We're going to talk about that below. But if you think that the original agreement was 1.8 million barrels a day, and we saw how long it took for worldwide inventory to reach balance, we start to understand why this huge increase in production is concerning traders. And also the other factor is the intangible, which is we don't know what we don't know. We know that production figures lag. We know that despite the best efforts of the IAE, the EAI, and OPEC, we don't really know exactly what production is, and we know that it tends to be lag in the official reports, and every indication is it's probably more than we think it is. So that's causing some concern. So a corollary to the amount of oil that we're producing is the amount of oil we have in storage. I'm going to look primarily at U.S. data because in regards to the amount of oil in storage and the amount of oil produced, U.S. is one of the most transparent countries, and so it has probably an overly high impact on markets, but it's an important indicator. So one of the biggest things I think weighing on oil going into 2019 is that our storage, or the amount of oil we have in storage, has been increasing. And to give you guys again some historical context, I prepared the table below. If you look, when oil hit its high in approximately June of 14, or I say high, recent high, there's about 350 million barrels in storage. Oil hits 50 in March of 15, when there's about 415 to 437 million barrels in storage. Why is that significant? Because we're $50 a barrel again, and lo and behold, we got 441 million barrels in storage. Coincidence? I think not. So oil then bottoms out again and hits basically rock bottom approximately January of 16, and U.S. storage has got 450 million barrels. So we're beginning to detect a pattern. Now that eventually reaches a high of about 535 million barrels in March of 17. And the good news is we did see some drop off, right? OPEC passes its deal and everything is going great. U.S. storage drops to about 394 million barrels, but now it's climbing again. And that's, I think, what has traders a little spooked and has markets spooked. Because, as I said, as of last week, we had 441 million barrels in storage, and that's about 7% above the 5-year average. But I want to make a note on that. The 5-year average was the target that OPEC gave us for when they would view oil markets to be in balance and when the production deal would expire, right? We heard a lot of people talking about, well, we want oil to be within the 5-year average. Okay, great. The problem with that is that the 5-year average includes years that we know we had a lot of oversupply. So I'm not sure that the 5-year average is a good metric for how in balance oil markets are. But regardless, if you look at US data, we're about 7% above the 5-year average. If you look at OECD data, OECD data shows that in October, the amount of oil in storage was 2.872 billion barrels. That's a lot, but it's also the first time that it has been above the 5-year average. So you see this amount of oil in storage and you see it increasing, which is causing a lot of concern, particularly in light of the record production we just talked about, in light of the fact that those production figures lag. And then I've also prepared another chart for you. So if you look at the chart that I'm putting up now, what you'll see, and what I found interesting, I kind of went back and looked at the history of this, is when you see a fairly rapid decline in oil price, you also see unexpected builds. And so looking back at it, I've given you just kind of the recent history, but you see analyst consensus expectation kind of average there, and then what actually happened. And you see it happen consistently over at least several weeks, and only a month or more, where inventory, U.S. inventories in particular, build more than analyst expectations. And I think that the concern there is the obvious, that the production figures are lagging and they're much higher than we think. And that leads to a drop in the oil price. But in this case, I think is also indicative of a significant headwind facing our industry, which is that not only is the production rising, the storage is rising, and we just don't have a lot of room for error. So when we talk about OPEC cutting, and I say OPEC plus its allies, and Russia plus more, 1.2 million barrels a day, we're sitting there going, well, we already have all this oil back in storage, and we need something to adjust this market fairly quickly. And will they be able to do it? That's the question. So far in our discussion, we focused on the supply side of oil, and now it's time to look at the other side, demand. One of the headwinds facing oil heading into 2019 is that the demand side of the equation is fairly uncertain at this point. While it's always uncertain and hard to predict, one thing that we've seen is that every major agency has revised downward their forecast for worldwide oil demand this coming year. So the EIA had originally been projecting around 101.76 million barrel per day demand, and they've now forecast that down to 101.51. OPEC is now projecting demand growth at 1.29 million barrels a day, but that's down 70,000 barrels per day from last month, and it's the 4th consecutive month that they've lowered it. The IAE has also lowered their worldwide demand growth from 1.4 million barrels a day to 1.3 million barrels a day. Now, you can see in that huge differential between OPEC and the the IAE, that these are imprecise numbers, but what you do see is a consistent trend. The people that are calling this, that have the expertise in it, are all calling for less demand growth and lower oil demand than originally forecast. Now, clearly a number of factors play into that. If you look at Goldman Sachs, they have predicted that the U.S. economy will grow at a lower pace than they originally anticipated next year. The OECD has dropped their projection from for worldwide economic growth from 3.7% to 3.5%. And you see some economists who are indicating that they believe that there's a higher probability of the U.S. entering a recession next year. Now, most don't believe that's going to happen. That's the positive news. But the percentage that believe it's possible has increased. So I think that you see some of that going on. I think you also have a lot of existential threats that are kind of atypical. Brexit is probably posing a problem. The looming and potential trade war between the United States and China is posing a problem. All of those things are weighing heavily on the question of demand. And I'm showing you sort of the bullet points here, but then the next table that I'm about to show you shows you that we have moved into a period where the IAE is predicting supply to outpace demand through next year. So those factors, I think, are really what's driving this temporary, hopefully, problem with the market. I hope that we see some balance with the OPEC decision we have now. I'm going to talk about that in the next section. I want to talk about the positive things, which I'm going to go through fairly quickly. But if you look at these charts, I think, particularly from the IAE, you'll see some of the issue going on and understand why we've had this sudden sort of price correction in oil. All right, so the last thing I'm showing you now is the futures curve. This future curve was from a couple of weeks ago. I actually haven't gone back to get an update. But what you see is that we now have oil trading in contango on a 6-month future curve. That means, for lack of a better word, that the money is coming in on there being too much oil in the market. So I want to show you that just to tell you that's where Wall Street thinks we're headed, at least in the short term. Now, we see that those guys can change their mind pretty quickly, and hopefully they do. But next I'm going to give you the positives. I kind of feel like I've given you the negatives, so let me give you the positives, and then after that we're going to talk about what I think that means for our business in 2019. So I've given you all the headwinds facing oil for 2019, and right now it looks like a gloomy picture, but I want to bring it back to some of the positive things. First of all, the OPEC deal, another one. OPEC has agreed to cut 1.2 million barrels from production. That's basically Saudi Arabia and Russia really carrying most of the cuts, with Saudi Arabia carrying the laboring ore on that. While I don't know if 1.2 million barrels a day at its current state is enough to bring inventories back into balance and start reducing those inventories, what it is to me is a symbolic move. It's Saudi Arabia once again assuming the role as swing producer. Remember that when they started this war on U.S. shale and they decided to keep the taps open, they really thought they were going to win. They thought that they would drive a bunch of U.S. producers out of business, and they didn't. They struck a short-term victory. They reduced U.S. production down to 8.4 million barrels a day, but now it's 11.7 million. So they lost the war, and they fought an expensive war. So the chart I'm showing you below is their foreign currency reserves. When they started this war, they had over $750 billion. Now they got a little more than half of that. So the reality is they can't afford to do round two. They know they can't afford to do round two, and they don't want to do round two. So seeing them assume that role as swing producer and basically saying, we are going to take the laboring ore on this, we're going to do it, is overall net positive for markets, is positive for United States oil production. It acknowledges our new role as the global leader in production, and also acknowledges the fact that the government in the United States can't control it. Well, they can, but they can't. We in the United States leave that open to the free market. So that's positive. And the next thing I'm showing you that I think is hugely important is the number of drilled and uncompleted wells. DUCs have continued to rise. And that's important because when you go into a downturn like this, your DUC count is something you want to look at to know what A, oil companies are anticipating doing, but B, you know that they've already sunk half their costs. Now, before the downturn, that was actually a little bit different calculus because the cost structure was a little different. But from what I read now, about half of it goes into drilling, about half the cost goes into completing it. So with a large number of DUCs out there, we know that they've already sunk half the cost, and quite candidly, to keep production up, they only got to sink the rest, the remaining half. That's particularly important given that fracking wells still produce upwards of 90% of their production in the first 3 years. And so wells started in 2016 are starting to peter out on production. And so just to keep cash flow going, many of these companies are going to have to produce. So that's good. The other thing that's positive is pipeline capacity. About half the rigs operating in the United States right now are operating the Permian. So the problem in the Permian is that right now there's simply not enough pipeline capacity to carry that oil out in an efficient way. But I believe it's 3, it may be only be 2, but I think 3 new pipelines are coming online next year in the Permian that'll carry that oil directly to Corpus Christi, which will be great because then it can be exported and make its way around the world. So that's positive. The other thing that's positive is because of the price spike up into the 70s, you have some hedging taking place. You had some oil companies lock in their hedges, which means that they're profitable because they don't really care. They've already got the price locked in where they want it to be, so they have every incentive to drill. So all those things are positive. I don't want you guys to think it's all negative news, but there are some headwinds, and those headwinds cause me some concern. So right now we don't know what E&P budgets are going to be next year. WoodMac had originally been forecasting them to increase. I think that the kind of consensus I'm reading now is that they'll stay flat or there's be a slight decrease. The only major to announce so far is Anadarko, and Anadarko cut their E&P budget. So while I'm not happy with that, it wasn't cut that much. But remember, $50 is an inflection point. Continental Resources, Harold Hamm, has stated that at $50 a barrel oil, he's going to start reevaluating projects. And according to him, Continental is profitable on some of their projects at 40 a barrel, but he's not going to give away his reserves for low margin. It makes sense, but I don't know how bad Mr. Hamm needs cash flow, and so that analysis on his part may change, particularly in light of any hedging he has in place. But either way, the reason that I think that we should all get a little nervous when oil approaches 50 in the United States is that is a key inflection point for Continental, for EOG, for Withings. All of those have indicated that $50 is the point where they reevaluate. But here's what I think. So let's get into Ty's takeaways. Ty's takeaways for 2019. We are forecasting a relatively flat year with either minor expansion or contraction. I don't think you're going to see much either way because I think that companies are going to take a sort of cautious view. I think that's particularly true in light of the fact that a lot of the production that's coming offline is an artificial constraint. Of course, you see, your typical supply chain challenges, whether it's in Libya or Venezuela or other countries that have some supply chain issues. Either way, when you see Saudi Arabia, when you see Russia, when you see actually Canada this time, all sort of moderating supply for one reason or another, I think because it's an artificial constraint rather than a result of natural declination, you have to be cautious, particularly in the oilfield services industry. So we are very cautious about what next year is going to bring. That having been said, I'm also not panicking. I don't feel like we are worried that you're going to see some sort of major contraction like you did in 2015, 2016. I think that relatively everything's going to stay fairly flat. You're going to continue to see some of these drilled and uncompleted wells being complete. You're going to continue to see E&P activity. All of that's going to continue to happen. I think when the pipelines come online, you're going to see some rush around that. So I think all of those are positive. In terms of how we approach our business, it's largely going to be the same as last year, with a slight difference that I don't think we're in as big of a hurry for growth. Last 6 months ago, I was buying every stick of steel I could get my hands on, particularly for the sizes that you guys are all demanding and I run out of. If I could find it, I was buying it. Now I'm going to buy it, but I'm only going to buy it if I love the price. So that's a small difference, but a difference. The other thing that we're going to do is our CapEx budget. We had budgeted more money than we're going to spend next year. I've decreased the CapEx budget. So I'm also, we're going to hire people at the beginning of the year, and we're now kind of moderating that, and we're going to take an eye and keep an eye out. So overall, Ty's takeaway, I think, is that you don't need to panic, but I certainly wouldn't go out and spend a lot of money on CapEx expenses and other non-recoverable expenses. I would keep my expenses variable as much as possible rather than fixed, and I would just keep an eye on growth and trying to make sure that you're in line with what's going on in the market. So those are my takeaways. I hope you enjoyed this video. Again, from my family, from the bottom of my heart, Thank you for your friendship. Thank you for your business. Thank you for your support. We look forward to talking to you in 2019. And if you guys have any questions, feel free to call me, email me. Most of you have my email address, and a lot of you have my cell phone number. I'm getting ready to head for vacation, but I will be driving, so I'll have plenty of time behind the windshield to visit with you about oil pricing, steel pricing, and what other questions you have. So again, Merry Christmas, Happy New Year. Thank you for all your support and friendship.